Hi everyone. A very good evening to all of you. So this is Monisha. It's my pleasure to be your moderator for today's webinar. I welcome you all to the Startup CA series. So this is a collaborative effort between the Shine Foundation and Institute of Chartered Accountants of India, Mangalore branch. In today's session, we will explore basic bookkeeping practices for startups, a critical component for any emerging startups. So effective bookkeeping is essentially for tracking financial performance, ensuring regulatory compliance, and making informed business decisions. So by the end of this today's session, you will have a solid grasp of bookkeeping essentials that can help your startup future. So now let's welcome our esteemed speaker for today, CA Deepika Pai. I welcome you, Deepika.
So much, Monisha.
Ms. Deepika is a chartered accountant and an associate partner at DCL India. So she brings a wealth of experience in financial analysis, taxation, and corporate financial services. With a proven track record of delivering accurate financial reports and ensuring regulatory compliance, she excels in budgeting, forecasting, and strategic financial planning. So, Deepika's proficiency in accounting software and advanced Excel functions, coupled with her strong analytical skills, make her a valuable asset in driving business growth and efficiency and in startups. So, a warm welcome to you, Ms. Deepika, once again.
Thank you.
We all know that incredible value CAs bring to the table for companies of all the sizes. So they are the backbone of financial guidance for all the startups. Without the expertise of CAs, a startup's journey can be a fraught with challenges. So their guidance on financial strategies is essential for a startup success. So building a strong startup requires a solid foundation, and CAs play a vital role in laying that foundation. We are thrilled to have a prominent member from Institute of Chartered Accountants of India with us today, CA Gautam Pai, Chairman of Mangaluru branch. I welcome you, sir.
Thank you, Monisha.
So I also want to extend a warm welcome to our esteemed partners who are instrumental in engaging startups and students. I would like to acknowledge the strategic partnership of the Karnataka Digital Economy Mission, KDEM, which plays a crucial role in fostering innovation and entrepreneurship in all regions. We also extend our gratitude to our ecosystem partners, Inunity Innovation for Community, Emirise Foundation, Will Grow, Siddhaganga Technology Incubator, GINSERV, Manipal Universal Technology Business Incubator, AIC Nitte Incubation Center, and Derby Foundation. A warm welcome to all of you. And of course, a warm welcome to all our audience members and participants. Your presence and participation are what make this session truly valuable. So this Startup CA Conclave series is a collaborative initiative led by CAs and Sign Foundation. We are excited to bring you 12 insightful webinars culminating in a final conclave event. This is the second session in the series, and over the next 10 sessions held monthly, we will explore various topics critical to startup success, including legal structures, fundraising, financial management, etc. So throughout the webinar, I encourage active participation from our audience. Please feel free to ask questions using the chat feature, and we'll address them during our Q&A session towards the end. And without a further ado, let's get started. The floor is yours, Deepika.
Thank you so much, Monisha, for the wonderful introductions that you've provided. And thank you, Gautam, for this opportunity. Thanks to Shine Foundation and the entire ICI fraternity for giving me this opportunity to talk on the not so discussed topic related to the startups, that is the basic bookkeeping practices. To start with, I think in the first session, right? So you had a lot of brainstorming on the business structure of startups. You discussed on how to raise the capital. I think there were discussions also around how to do a startup business and more on regarding the startup India, right? So today we'll discuss more regarding the bookkeeping aspects that a startup is required to follow. So just Monisha, just let me know when you're able to see the screen.
Yeah, sure.
Just taking some time. Hang on, guys, just a couple of minutes. Just checking.
Hang on, guys. The speaker will be back. Yes, it's
Monisha, just confirm
yeah,
if you can
it's
see the
visible.
screen and if I'm audible.
Yeah, you are audible.
I am
Yeah.
really sorry for that. Yeah, okay. I'm really sorry for the technical glitches that I had to face. So the whole of this session, we would cover the bookkeeping basics and the bookkeeping principles. And then lastly, we will have some question and answers round. Okay. Now to start with, uh, you can see the quick outline of today's session, wherein we will discuss about the basics of bookkeeping. That is, what is bookkeeping, why to do bookkeeping, and then regarding maintenance of the financial records, why and how do you maintain the financial records. Next, the tracking of the incoming revenues and the outgoing expenses. So that will be discussed in the first segment. The second segment is where we will discuss a lot about the bookkeeping principles that we have. There are many, but I'm going to discuss the 10 most important ones. A couple of financial key terms that you as a startup entrepreneur should know about. Uh, a crux of the bookkeeping process, that is the types of accounts, the journal, the ledger, the trial balance, and a bit more regarding the financial statements. And lastly, regarding the compliances, that is what is compliance, why to do a compliance, and what are the basic compliances that we have in India. Okay. Now, what is bookkeeping? Yes. Now, what is bookkeeping? If anybody can explain me briefly what is bookkeeping, if anybody has an idea. Keeping a book, right? Yes, what is a bookkeeping? Okay. So if I go by a very traditional approach, it means simply recording of the transactions. Okay. So if you simply have a transaction, let's say you start the business with a capital, or you purchase some goods, you make some sales, you incur some expenses, you pay off the salary to the employees. All these are several financial transactions. Simply recording as bookkeeping is a very traditional approach. Okay. But if I look at a very sophisticated, holistic approach wise, what is bookkeeping? It is the entire process of recording, classifying, you summarize, you report, and you interpret. So it's a wholesome approach wherein you do all these bits and pieces and then give the report to your users of financial information. That is your investors, your government, yourself, a lot more other people. Okay. So as I said, this is the entire wholesome approach of bookkeeping. Now, what is the difference between bookkeeping and accounting then? It can be interchangeably used these days. Okay. So to be more precise regarding what is recording, as I said, I have listed down a lot of financial transactions. You investing a capital into business, you purchasing some goods, you purchasing an asset, you making some sales, you incurring some expenses. When you capture all this financial data relating to your business activities in a proper systematic record, which is called a journal, it's called recording. There are no doubts regarding what is recording. It's simply but keep capturing all the financial data relating to the business transactions that you have. Now, once the recording is complete, the book that you maintain for recording is called as journal. Now, the once you complete the recording process, next that you have is called classification. Now, let's say a small expense that you incur every month is rent, right? So you incur rental expenses every month. Like that, you incur for the whole year, right? So every month you have to pay the rent. So for the whole year, you will have 12 transactions related to the rent, correct? Yes. So at the end of the year, you will have 12 transactions. Now, summarizing, putting all this rental expenses into one account head, that is rental related account head, is called classification. So classification comes after your recording. It is nothing but identifying all the similar uh, transactions, like rental expenses is all grouped under the rental head. Salary, you pay pay monthly payroll, right? You pay monthly payouts to the employees. Considering all the salaries of all the month and putting it under one head is called classification. Again, you buy assets, like maybe you buy laptops, you buy computers, you buy the CPU, you buy the keyboards. All these are assets which can be grouped under one particular head, that is computer and computer related accessories. So this is classification. I hope everybody got the crux of what is classification. Now, one step ahead, that is nothing but summarizing. Now, what is summarizing? You have several types of accounts. You have assets, you have liabilities, you have incomes, you have expenses, you have equity, right? That is nothing but the capital. Now, for all this, you would have the total balance that you have incurred or you have established during the end of the year. Now, pull out all those accounts, okay? See what is the closing balance of each of the account and prepare a summary report. That is nothing but the trial balance. So this is called as summarizing. So it is a process of placing all the balances that you have under numerous heads that you've just classified now, putting it into one table format and placing the balances, the closing balances against each of that account is called summarizing, nothing but preparation of the trial balance. And lastly, with the help of the trial balance figures, now you know what is the total balances of the assets, you know total balance of liability, you have that's revenues, you have expenses, you have all the details with you. Now you prepare what is called as financial statements. That is, you prepare the profit and loss account, you prepare cash flow statement, you prepare the balance sheet. That's nothing but reporting. Okay. And lastly comes interpretation. Interpretation is wherein you provide the users of financial information all these reports and give them the results. Tell them, okay, so and so is a financial position of the business. So and so is the financial performance of the business. This is our cash flow. This is from where we have received, we have made these are the cash inflows from so and so activities. From financing activities, we have so much cash flow. For these are our spendings. You give them a detailed report, detailed analysis, detailed interpretation of the results of the business, and that is nothing but the interpretation stage. I hope everybody is clear with these 4 crucial steps of bookkeeping. Okay. Now, I just mentioned the users. You have to give the reports to the users. I mentioned you have to provide the interpretation to the users. Now, who are these users? Why are they called users of financial information? That is because they are interested to know what is happening in your business. So can anyone tell me? I know it's on the screen, but whom do you think are the users? First of all, it's you. That is nothing but the owner of the business. It's a user, right? The investor, the people who have invested in your business are the users. The lot of tax authorities, they are the users of the financial information because they do ask the reports from you. The government, auditors, the lenders, your customers, your employees, all these people are users of financial information. So I can bifurcate the users as two. One is the external users, and then you have the internal users. Wherein you can see on the screen, the external users will be your lenders. That is, if they have given you the debt, the bankers, the consumer creditors, and lastly, the government. And now, who are the internal users? It would be the owners, the employees, and the internal audit. So if everybody is okay with the slide, I can go on to the next. All right. Now, why to do bookkeeping for a startup? What are the benefits you will reap as a startup if you do a proper bookkeeping? The whole of this can be classified into 4 segments. Okay. One is to know the financial visibility of the business. 2, for the sake of compliance and taxes. 3, for the sake of strategic decision making. And lastly, from the investor perspective. Now, financial visibility. Say we are all students, we are going to the school or colleges, respective colleges. Okay, we study a lot of things there, but there are no exams. There is no evaluation. How will we assess the performance? Not possible, right? It is bookkeeping is similar to our examination, wherein we are tested. The business is tested, the startup is tested, so that we get to know the performance. What is the financial health? Whether we are performing well, whether our performance is whether the performance of a business is good or not. That is nothing but financial visibility. So you will be able to track the cash flows, your profitability, and business value with the bookkeeping concept. Now, what is financial status of business? How your business is doing? What is cash flow? Now, of course, you will have invested a lot of funds into the business now. You have invested a lot of things into your startup, your efforts, your money, everything goes into a startup, right? Now you want to know where you're spending the money. Where, on what activities are you spending? Are you spending on the operational activities? Are you spending on the buying the assets? Are you paying out so much of interest to others? Are you paying a lot of financing activities? Now, this is again, from where will you get all these inputs to assess the cash flow information? Again, from bookkeeping. What about profit and loss? How will you ascertain the profit and loss? Without bookkeeping, impossible to understand what is your profit or a loss. Business valuation. Now, what is business valuation? Nothing but knowing what is the value of the business. Why should you do a business valuation? Should do a business valuation because investors are interested to know the value of business. They will not invest until and unless they foresee a good business value, right? So now, what will be the striking factor to do a business valuation? You need a historical financial records. There is data required. Now, from where do you fetch the data? Again, linked to bookkeeping. Next, ensure accurate tax filing and claim eligible deduction, carry forward of losses. This is a gist of what will be covered under compliance and taxes. Now imagine you spend around 1,50,000 rupees for some expenses, okay? But you record only 1 lakh in the bookkeeping. So you are recording how much less of your expenses in the books? 50,000 less. There is under booking of expenses to the extent of 50,000. Now what happens is when you're filing your taxes, you can claim the deduction of expenses only to the extent of how much you have shown in your financial records. How much is that? How much of that is shown in the financial records? 1 lakh. That 50,000 benefit is gone. So be very careful and see that you show all the business expenses that you have incurred properly in the books of accounts so that you do not end up paying higher taxes. Next comes tax compliance. Again, there's a lot of statutory requirement to maintain the books of accounts, to maintain proper records. So for tax compliance, now carry forward of losses. Most of the people have this dilemma that have this thought that okay, we are incurring losses, then why should we do bookkeeping, right? I mean, however, we don't have to file any, we don't have to report any profits to to the government, then why keep bookkeeping? This is the usual approach, but that's not right. You are not going to run into losses forever, right? You will make profits some or the other day. Maybe in the first 2 years, there may not be profits, but subsequently you will make a lot of profits. Now, what happens is there is a concept of carry forward of losses in income tax, which allows every business to carry forward its losses for the 8 assessment years, for the 8 subsequent years. Now, imagine you don't do a proper bookkeeping, you have no records of your losses. What is going to happen then? You cannot take the benefit of offset of these losses against your future profits if you do not have a proper booking record and if you do not file your taxes within the due dates. So that is when it comes to carry forward of losses. Again, lastly, the statutory requirement. Again, there are a lot of laws that require you to maintain the bookkeeping records. And if you do not do so, what will happen? Penalties. You will have notices. Now, remember one thing about penalties and notices. Penalties are non-productive costs that you incur. It will not give you any benefits in the future, right? It is non-operational. It doesn't reap any benefits to you. Same comes with notices. How much of your time goes into personal hearing, responding to the notices? So it is always good to be on a legal side and see that you do a proper bookkeeping. Next comes strategic decision making. Now, it is only when you have a proper bookkeeping, you can compare yourself with your competitors. You can compare your results, how you're performing, what is your profits, what are your expenses to the industry standards only when you have the proper bookkeeping data. Strategy building, business analysis. Now, what is strategy building? You strategize which segment is good for you, which product of yours is making good, which service you can sell out more, on what segment you should concentrate so that your business expand. All this is possible only when you have a historical financial data of how you are performing. A lot of details of your performance of business in terms of your operating cost, operating revenue, how much you should spend on a particular asset, how much of your liabilities you can pay off. All this business analysis can also be done only when you are backed with a financial data. Also, as a whole, you will have an eye on your financial progress, whether you are performing good, what measures you have to take to progress well. Lastly, from investor perspective, so tell me one thing: you as a owner of the business will always try to maximize your wealth and minimize the cost, right? So your agenda is nothing but to make profits, to maximize the wealth in the overall future. So that can be possible only when your expenses, when you're doing a budget and having consistent comparison of your actuals with the budgets. You want to look at your financial ratios. Now, investors will not have so much of time to look into all the numbers of yours, like your operating expenses, your operating revenue. They're not concerned with the numbers as such, but they're only concerned with the visual reports in the form of financial ratios, trends. all these ratios and trends, from where can you provide a genuine data to the investors? It's only when you have a proper bookkeeping. So that's regarding the benefits of bookkeeping. If you have any queries, you can raise. Otherwise, I can move on to the next point, or we can handle the queries at the end of the session. All right. So moving on to the next, that is keep accurate financial records. Now, usually this question, I mean, a couple of questions have been raised as to how can we maintain financial records? How can we know that whatever we are maintaining is correct or wrong? So to begin with, the first thing is separate business and personal finances. How to do this? Any idea how to have a separate business and personal finances? It's a very easy step on how we can separate the business and personal finances. Simply open a separate business bank account, have a separate credit card for the purpose of business. Do not mix your personal finances with the business finances. Now, what happens if you mix? It is very difficult to track your expenses. It is very difficult to track your incomes, and there's a lot of confusion around. So to make the bookkeeping easier, make sure that you maintain separate records, separate bank account and a credit card for your business. Next is embrace daily record keeping. Now, what is meant by daily record keeping? Do not pile up your transactions. Don't say that, okay, the transactions are 2 or 3. Let me do it all together. Let me do it at the end of the year. No. Do do not pile up the transactions at any cost. Have a monthly check, weekly check, or monthly check based on the volume of your transaction. See that you record it uh, on a frequent basis. Next is use of accounting softwares. There are the market which have eased the bookkeeping process. It has simplified the accounting process. You do not have to stress much on bookkeeping. You can focus more on your business growth, and you can get a lot of automated reports or a lot of informative reports if you have a proper accounting software installed. Hold on to bills and invoices. What is this? Hold on to bills and invoices. It's nothing but you keep a record of all the bills and invoices. Your accounting is based on objective evidence concept, which means that whatever transactions that you record in the books of accounts, you should have an evidence for that. For example, I simply cannot book the rental expenses as 50,000. I should have a proof for that. What is a proof for having a rental expense of around 50,000 a month? Obviously, the there are two proofs here. One is the rent agreement and the other one is the rent receipt that I get from my landlord. Okay. Also, there is one more proofing, that is nothing but the bank payment that I make. There is an entry in the bank records, right? So these becomes the 3 objective evidence for my bills. Now, again, salary. I have the pay slips that I have issued to my employees, right? So this again becomes an objective evidence. Again, hold on to the invoices as well. So whenever you issue the invoices to your customers, make sure that you have a copy of it, signed copy again. Next is reconcile bank statements regularly. Now, there are a lot of startups that simply record the bank transactions on the basis that they have sent money, they have received money. Okay, it's like it's half bank statement accounting. They do not pull up the bank statement from the bank software. They from the net banking software or for the online banking. They simply do it on the basis of what they remember. Wrong, completely wrong. So make sure that every month end you reconcile the bank statement and the balance of the bank account as per your books. So that is nothing but reconciliation of the bank statement. Now the next part is consider professional help. You might belong to a different stream, right? You might be a doctor, you might be an engineer, and you have a limited commerce and accountancy knowledge. So do not do it yourself, right? Do not DIY. Sometimes you need to seek professional help. Feel free to do it and do not hesitate. You can do two things when it comes to considering the professional help. Either you can go for an in-house accountant, right? Or you can outsource the bookkeeping process. The next thing is think long term. Now, what is this think long term? Now we have just started the business. It's just in a budding stage. Maybe the next 6 months we don't have to do a big bookkeeping. Wrong again. So what is think long term? Make sure that you think of the future. When the investors comes in, the first thing that they ask is your financial records. Now the financial records again is required from the scratch. It is required from the day of your commencement, not just when you want to present it, right? So think of a long term, think of securing a funding, keep proper financial planning, and make good decisions. Lastly, back up the data and preserve the books of accounts. Now, there were questions. Can I go for a free accounting software? Now, free accounting software will come, but at a with limited features, limited storage capacity. There are a couple of entries not available in the audit trail. There are a lot of complexities when you go for a free account that you get from the free accounting software. So we suggest go for backing up the data and preserve the books of accounts. Now, preserving the books of accounts again is a statutory requirement. So if you're doing, if your startup is a company, and of course you will have to comply with the Companies Act, and it requires that you have to preserve the books of accounts for minimum 8 years. Okay, so that's regarding keeping accurate financial records. Okay. Now, going on to the next slide, that is where we will discuss about tracking of expenses and your revenue. Now, revenue is nothing but the income. It's nothing but the turnover. It's nothing but the sales that you make. And what is expenses? I'm sorry. What is expenses? Expenses is nothing but what you expense out, what you incur out to earn that revenue. Now, how do you track the incoming revenue? First of all, identify revenue streams. Now, what is identification of revenue streams? You have sale of product, you might have sale of service, you might have subscription income, you have some interest income. So keep a track of what are your major revenues. Also, do not let your surplus, see, suppose you're making a lot of sales and you have a lot of cash balance available. Do not make it idle. Do not make the cash amount sit idle in your books. What can you do? Instead, you have to invest it elsewhere. You can put it in mutual funds, you can put it in FDs, and you can earn some money identifying what is your revenue streams. Next is sales tracking, very important. We have seen several startups that have an issue of income leakage, the CPA, leakage of income. That is, they do a lot of, they put in a lot of efforts, they do a lot of service, they give a lot of services, but they fail to bill.
Hello, Deepika.
That is, yeah.
Yeah, sorry to interrupt. I guess your network issues are there. So if you are facing audible issues.
Is it still there? Just give me a minute. I'll change the network in that case.
Yeah.
Just let me know if there is once again an issue. Okay. Is there an issue now, Monisha?
Audience, just yeah, for me it's fine. Can you other guys just drop a chat in chat box? Is it okay now? Can you speak, Deepika?
Yeah. Hi. Audible now. Is there an issue?
Yeah, fine, Deepika. And we have a question. We have a question. So in the middle, we can take a break and answer those questions.
Sure.
Okay, yeah.
Yeah, I'll complete this first segment, and then we can take up the questions. Also, Monisha, I'm not looking at the chat box. So in case if there is an audio issue, please just let me know.
Yeah.
Please feel free to let me know. Okay.
Yeah.
All right. Thank you so much. All right. So going back, we were at sales tracking. Now, what is meant by sales tracking? As I mentioned, there's a lot of income leakages that every startup faces. Now, how do you avoid this income leakage? That is by tracking the proper sales. How do you track? You can use softwares again. You can use CRM. Okay, and then if initially to start, you can use a spreadsheet. You can use an Excel sheet. But make sure that whenever you provide a service, you bill that client. And next comes the payment processing. Now, what is meant by payment processing? Whenever you issue an invoice, make sure you can use the software such as Stripe, you have PayPal, you have Razorpay. You can implement all this, and you can ask your clients directly to pay you through those links. Okay, and then integrate these softwares with your accounting software, with the bookkeeping software, so that everything is automated. Next is invoice management. Now, what is meant by invoice management? You have to issue a proper professional invoice. There are chances that your client companies, that your customers will not pay you on time. For example, there is no date in the invoice. If you see this invoice that is displayed on the screen, can you see the date mentioned? No. They have that, you have to pay within 14 business days of invoice date, but nowhere the date is mentioned. I think there is some internet issue. Let me do a thing. Okay. So, yeah, there is no date mentioned here. So this is not a proper professional invoice. See that you give the description of the item. You see that there is a GST mentioned if you are a GST service provider, or if you're GST registered, you have your PAN mentioned, because sometimes they do TDS deduction. See that everything on your bill is complete. Because the moment you send an incomplete professional invoice, they are going to send it back again. Your payment is delayed. The moment your payment is delayed, your working capital is stuck in debtors, right? So there's a lot of income leakage again when it comes to an improper invoice. Lastly, recognition of correct revenue. Now, what is recognition of correct revenue? I'll give you a simple example. You have a service agreement wherein you have to provide the service for the next 2 years. I repeat, you have a service agreement wherein you have to provide service for the next 2 years. And the total bill amount is 2,40,000. Let's say the total bill amount, the total invoice that you have raised is 2,40,000. Tell me, ideally, how much should I recognize for the year 2024? Let's say the agreement starts on 1st of January 2024. It ends on 31st December 2025. So it is altogether 24 months. I have 2,40,000 invoiced to that client. The client pays me directly 2,40,000 on 1st of January 2024. Tell me, what is the correct revenue that I should hit the profit and loss account for the year 2024? Should I consider the entire 2,40,000 as my income for the year 2024 is my question. Yes, team. Can I expect some answers? I'm looking at the...
Just a second. I had, yeah. Yeah, I have enabled unmute options. You can unmute yourself and answer her.
Please speak up. Should I repeat the question, anyone? I think we have some answers.
Can you pardon that, ma'am?
Can you repeat the question?
Yes, of course I can do that. Let's say you enter into a service agreement with your customer, okay? And it is entered on 1st of January 2024. It is to render the service for the next 2 years, that is for a period of 24 months. Your agreement ends on 31st of December 2025. The total amount that you have billed to the client is 2,40,000. You have received it. My question is, how much revenue should be booked for the year 2024? That is from 1st Jan to 31st December 2024.
Since the client sent you all money, I think all money would be billed, I guess, ma'am. Yeah.
Okay, let me answer this. Your service tenure is for 24 months, right? right? You will be providing the ongoing service for the 24 months. So the correct revenue that you have to recognize for the year is only for 12 months, which is only 1,20,000. The moment you recognize 2,40,000, what happens? You're paying higher taxes this year. Next year, you may not have any revenue, right? So your taxes are higher this year, which you could have deferred to next year, which you could have saved it somewhere else. That's not right. So having recognition of correct revenue is very important. I think if anybody has a doubt, I can repeat this answer. So your tenure is for 24 months, right? The 24 months revenue is how much? How much per month is what you're servicing? 2,40,000 into 24 divided by 24. It's a 10,000 every month. Revenue per month is 10,000. So for 2024, it should ideally be 1,20,000, and the next 1,20,000 should be deferred to the next year, because you're not going to provide that service. You're not going to provide the wholesome service this year. There is a part of service that is deferred to the next year. So it is incorrect to recognize when you do not deliver a service in the same current year. I hope it's clear. So that's regarding recognition of correct revenue. Sorry, somebody is speaking.
Yes, ma'am. I had a doubt.
Yeah.
Hello. Yeah. So, ma'am, then how do we account for the total that is coming into our bank account?
Okay, that is where your journal entries come into a play. Now, as soon as you receive the money, you will record it as bank account debit, that is 2,40,000, to whoever, to the sales, that is 2,40,000. But that whole amount of 2,40,000 is not your sale from service. So portion should be deferred. Deferred means what? It is a liability. You're supposed to give out that service for the next year. So that much amount should be treated as a liability. It is called as deferred revenue. There is a concept of deferment of revenue. So that becomes a liability. So you will have to credit to that extent. Your sales will reduce to the extent of 1,20,000. You will have a liability created to the extent of 1,20,000 at the end of the year 2024. I hope this concept is clear. So the moment when you receive the moment when you receive it, you will have bank account debit with the entire amount. You have received the cash flow. There's no doubt with that, right? But since the total of 2,40,000 is not the sale for that year, you have to defer that portion of 1,20,000 for the next year. How will you defer it? You will create a liability called as deferred revenue. You will reduce your sale to that extent. So you will pass the entry sale account to deferred revenue. You'll get to know more about it when I talk about the other concept, the types of accounts concept. Okay, so that was regarding tracking incoming revenue. Moving on to next, that is tracking outgoing expenses. Now, first of all, what happens in a startup is we see a lot of incorrect expense categorization. Okay, so usually there's rent, you have to put it under rent head. So in the month of January, it is properly recorded in rent head. When I go to the next month, it will be recorded under office supplies. It's so much horrific to deal with the auditing of such kind of bookkeeping, right? Because there's no standardization, there's no consistency in expense categorization. Make sure that you do properly record it under the relevant head of bookkeeping only. So for example, if it is salary related, make sure that you put it as salary only every month. Do not change it as a professional fees. So correct expense categorization becomes very important. Next that we face is capital versus revenue expenses. Now, I want to brief a little more about this capital and revenue expenses. Now, what is the difference between a revenue expense and a capital expense? Revenue expenses are operating expenses like your rentals, like your salary, like your repairs, your maintenance expenses, your admin costs. All these are revenue expenses. Now, what is capital expense? You buy an asset, you buy a computer, you buy a furniture, you buy a building, you buy a land. These are all capital expenses. Now, what is the difference between capital and revenue? Revenue is something that will help you to generate the revenue for the current year. And capital is something that will help you to generate the revenue for the next useful life of that asset. For example, when I buy a machinery, let's say 5 lakh rupees I invest on a machinery, it is not that I'm going to use it only for the current year, right? I'll use it for the life of that machinery. Till it is worn and torn out, I'm going to use that machinery. So that is why it is categorized as capital asset or it is categorized as fixed asset. The usual mistake that we find in books is there is no concrete bifurcation between what is a revenue expense and what is a capital expense. Even a furniture of rupees 50,000, a table that you purchase for your office is put under office supplies and it is closed. A printer is put under office supplies. Printer of rupees, let's say 25,000, the Canon printers are put under office supplies closed. Printing and stationery is what? When you go to a photocopy shop, get a printout, or you have some stationery expenses. That is printing and stationery. Printer is not a printing and stationery expenses. So there should be a bifurcation, a proper classification between a capital and revenue expenses. I hope this is clear. Next comes bill management. Now, what is bill management? Maybe you receive a digital copy of the invoice or you receive a physical copy. Document the same. Nowadays, you have a lot of softwares that enable you to attach the evidence to the entry that you have posted. For example, if it is printing and stationery expense that you have incurred, you will obviously have a printing and stationery invoice that the shopkeeper gives you. You can book it as printing and stationery expenses, plus you have an attachment field where you can attach the copy of that bill. So make sure that all the documents on the basis of which you have done the bookkeeping has been recorded, has been properly stored. Next comes bill payment processing. This is again another field where we face a lot of complexities when it comes to a startup because there's dual payment. There's no deduction of TDS. There's some statutory liability. That's nothing but the tax deduction at source, which you're supposed to do. You're supposed to comply with. You as a startup has not done that. That's again a non-compliance. So whenever it comes to bill payment processing, you have to know what should you do and what you should not when it comes to a payment. So you may pay through cash. You may pay through a bank account. You may pay through employee reimbursements. You may pay through credit cards. Make sure everything has been systematically recorded in the books. So avoid duplicate payments. You pay the wrong vendors. Again, completely wrong. You pay without deduction of TDS. There's also one more rule that law that says that's as per income tax, you cannot pay anything more than 10,000 in cash. It becomes disallowed as per income tax, but you still go ahead and pay in cash. Again, these are the consequences. So you should know about all this when you process a payment. Accounting software, again, what does the accounting software do when it comes to tracking of expenses? It gives you multiple reports. I'll do a thing. I'll just stop my video. I think that can help. Okay, I'll stop my video. I think that way I can have a good bandwidth, internet bandwidth. All right. So next is accounting software. So what does accounting software do? They help you track expenses. You can know your spending patterns. You can know where you have spent. Month-on-month analysis can be done. That is, let's say you have spent last month 50,000 on employee welfare expenses. This month you are spending 90,000. Now, why is there an increase of 40,000 in the expenses? Right now, this can be analyzed. You can just go into that report and see why there is a change in the expense. So that is nothing but the reviewing with the help of accounting software. All right, I think now I'm open for questions if there are any. We'll take a short break of like 2 minutes. We can answer your questions. I'm just looking at the inbox. Business loss carry forward is applicable to only private limited, applies to LLP. It applies to everyone when you're carrying on a business. For subsequent 8 assessment years, you can carry forward the loss. I am actually speaking loud enough, so just let me know. It might be because of the audio issues, my internet glitches. So just let me know if I'm not audible enough. Can you suggest some easy to use accounting software for non-accountants? For sure, it is coming up in the next slide. Are there any free software that you can use for bookkeeping? Again, coming in the next slide. Okay. Yeah, I've turned off my video right now. I hope the bandwidth gets better. Please suggest an accounting software. We'll do in the next slide. Can you also talk about standard payment procedure, when to raise a estimate, PO, invoice? When a client is interested in your business, you raise an estimate, you give them a quotation. Once they confirm, you issue they give you a purchase order. Okay, so the confirmation is always given from a client end to you as a purchase order. So now based on that purchase order, you have to prepare an invoice. And now regarding the credit cycle, it depends on what credit period you want to give out to your customers. So don't let your credit period be too much, because your working capital gets stuck. Again, standard payment procedure, make sure this is from expense point of view when it comes to standard payment procedure. So usually there will be deduction of TDS. If you are GST registered, make sure that you also add the right GST rate on the invoice. Okay, if there is TCS, even that applies. Okay. Yes, in case of services, it's statement of works. Atisha, you're right. If the purchase order comes into picture when it is more of goods in nature. I hope the audibility is much clearer now. Monisha, if you can confirm.
Yes, Deepika. Yeah.
Also, the other participants, if you are okay with the audibility. For consulting business, the GST rate is 18%, irrespective of what consulting you're doing. It is 18%. I'll take one more minute. If there are any questions, you can throw at me. Otherwise, we'll have to continue because there's a lot more to discuss. In dentistry, we do not have a clarity on what is the GST percentage on various services. How can I find out about the rate? Dentistry comes under medical, if it comes under medical diagnostic services, right? The service that you provide is medical in nature, it is exempt. But if you are selling out certain products, if there are goods involved, surgicals, equipments, then there is the rate which is applicable for the medicinal product as such, not medicines, the surgical equipments and all that. I can provide you my Gmail ID if required. You can get in touch for those queries if required. Yes, you will receive the recording of the session. All right. Thank you so much, guys. We'll move on to the next topic, the next segment, very crucial segment. I wish, I hope everybody pays a lot of attention to it, because it's more about the bookkeeping principles. The whole the whole of your bookkeeping concept is based on these principles. Now, when I say bookkeeping principles, there is a lot more to it. You have accounting concept, you have policies, you have conventions, you have the accounting standards, you have Indian accounting standards. So all of this is a vast ocean. Okay, so I haven't covered everything as such, but I've tried to put in what is important for you to know, for you to understand bookkeeping. Now, I'll quickly talk about the 10 pillars of bookkeeping. There are many more, but I'm focusing only on the 10 right now. Now, first one is separate legal entity. Now, the reason I told you your personal finances and your business finances should be kept separate is because of this concept, that is separate legal entity. Now, business is considered always separate from the owners, and that is why you are called owner to the business. You and your business are not the same. You are two different legal entities when it comes to law. So any of your personal transaction, you may travel to your hometown. That is not your business expense, right? So it should not come in the books of accounts. So there's only two things that comes into the books of accounts. That is when you withdraw funds or when you give a loan to the company, when you get some interest on that loan that you have given. So apart from this, nothing should affect the books of accounts because all of those are personal transactions and they are not related to your business. Next is going concern. Now, what is going concern? This is the crux because when you start the business, you have only one motive. Whatever happens, my business should run. It should run for a long period of time. It should operate indefinitely. So this is the assumption that every business makes when it starts. That is, the entity will continue forever and ever. So you have no plans of closing down at any cost. That is the assumption. That's nothing but the going concern concept. And that is the sole reason that we record our assets on their original and not at market value. Because we think that we have no intention to sell it. We'll retain it till it gives us a revenue generating value. Okay. Next comes monetary unit. Can I record the loyalty of my employee in my books of accounts? The question to you guys, can you record the loyalty? I have an employee who is working with me from the scratch. That is, from the inception, he's with me. Can I record his loyalty in books of accounts? Quick. No, I cannot, because it is not quantitative in nature. It is a qualitative aspect. None of the qualitative information I can put in my records, because it simply says only financial transactions which can be measured in the terms of money. Money can be anything. It can be dollars, it can be rupees, it can be anything, but it has to be a number. So without a monetary unit, you cannot record anything in the books of accounts. Next comes the matching principle. Now, what is matching principle? Again, a very interesting concept. I'll give you an example for this. Let's say during the year 2024, I incurred a manufacturing cost of rupees 1 lakh. I repeat, during the year 2024, I incurred a manufacturing cost of 1 lakh. I was not able to get any lead. I could not sell that product. There's a prototype that I've prepared. That prototype costs around 1 lakh. That's a manufacturing cost of 1 lakh. I could not sell that during 2024. I sold it in the very next year for 1,50,000. That is in 2025, I sold it. Now tell me, this cost of 1 lakh should be matched against that 1,50,000. How can I do that? That is when matching principle comes into account. It says that your expenses that you incur to earn a particular revenue should be matched against that. So ideally, this cost of manufacturing is nothing but the inventory cost of mine. I will move that to the next year. It becomes a closing inventory to me. I will move it to the next year. Next year, I will have a profit of how much? I will match the revenue with the cost, which will give me how much of a profit? 50,000 of a profit. I repeat once again, what is matching principles? Whatever expenses you have incurred to make some sale, to earn some revenue, should be matched against it. Okay, so that's why it says revenue recorded in a given accounting period should have an equivalent expense recorded so that I know what is my true profit. And that is where the formula is derived. Profit is equal to revenue minus cost. I hope this is clear. Okay, next, accounting period. Now I said going concern. Going concern means what? My business is going to run for a long period of time. But does it mean that I have to assess my results only at the end of that indefinite period, which is impossible? No, right? So I break up the whole of my growing concern into consistent periods wherein I will assess my performance, wherein I will know the results of my business. The performance analysis will be assessed maybe at a weekly interval, monthly interval, quarterly interval, or annual intervals. That is accounting period, wherein your complete accounting process will be for a specific operating period. Now, usually it is annually that we prepare the financial statements, and you can either follow calendar year or you can follow fiscal year. Fiscal year in India is nothing but the financial year that we follow from 1st of April to 31st of March. Next, going to the next concept, conservatism or prudence. Now, I'll give you a case. You have to tell me what will happen in this case, okay? Let's say there are two people, Mr. A and Mr. B. Okay, Mr. A files in the court for damages against Mr. B. So there is a court proceeding now wherein Mr. A has filed a case against Mr. B that he has to pay some damages to Mr. A. I'll repeat once again. Mr. A is there, Mr. B is there. Mr. A has gone to the court. He has filed a case against Mr. B wherein Mr. B has to pay some damages to Mr. A. Now, whatever happens, Mr. A is not going to lose anything because he will only earn in terms of damages from Mr. B. But for Mr. B, there is uncertainty regarding if he has to pay the damages or not. This is the case. Okay. For Mr. B, if he is running any business, he has to make sure that whatever damages, how much ever uncertainty is there, he may have to pay, he may not have to pay. The court will decide. But he has to record that. He has to make provisions for that in his books of accounts. This is based on conservatism or prudence principle. Now, Mr. A is seeking for damages. It is more like a gain for him, right? Now, that gain or that asset, that revenue, he will recognize only when the court passes the order that 100% you will receive this amount. I hope this point is clear. This is based on conservatism or prudence concept. So prudence or conservatism concept says that if you think, if you are not 100% sure, but if you think this will be the expense, this might come up, this might be the loss next year, this might be my liability next year, then you have to provide for it. But if you think this might be my profit, this might be my sales, this might be an asset to me in the future, then you cannot make provisions. You cannot show it in the books of accounts until and unless it is received. So that is meant by conservatism or prudence concept. Next comes consistency. Now, what is consistency? Today I follow cash accounting. Tomorrow I will do mercantile accrual accounting. Not possible. Today I will record the inventory at whatever is the market value today, or whatever is the invoice value. Tomorrow I'm going to follow some other approach for inventory accounting. Not possible. So you have to see that whatever principle, whatever accounting procedures that you follow should be consistent for every year, month on month, year on year. No changes. Changes can be done only when your law permits it. Law says you have to make this change, then you can do. Otherwise, you have to be consistent in your accounting approach. Now, because of consistency, what happens? You will be able to provide a lot of comparison. You can do comparison between the financial information of your of this year with the last year, or this month with the last month. So consistency will help with the comparison. Next is objectivity. I've already covered. What is objectivity? Make sure that every entry that is there in your books of accounts has a supporting evidence. Next comes accrual. Now, this is again very important concept. What is meant by accrual? I had given you the example of 2,40,000, right? So regarding the sale that was happening, 2,40,000 over 2 years. Now, that is linked to this concept. Irrespective of when the cash comes to you, it comes to you or goes out of your business, you have to record your incomes as and when it is earned. Earned means not cash related. Okay, it is when you provide the service or when the goods are sold. It is linked to earning.
It is not linked to cash inflows. Okay. You have to record it when it is earned, and expenses should be recorded as and when it is incurred, irrespective of when you paid. For example, for 12 months, I have recorded salary as an expense in my book. I have not paid my employees because I'm short of funds, but still it is this year's expenses only. I have not received from my customers any of the income. There's no cash inflow, but I have given them the service. I have sold them the goods. So that becomes this year's revenue only. So because from this, you will get the true picture of financial performance. I hope this concept is again very important. So whenever you make a sale, whenever you provide a service, irrespective of whether the income, that's the cash inflow comes to you or not, if it is earned during this year, you have to record the sale during this year only. You have to the revenue during this year only. Same goes with the expenses. If you incur it towards this year, you have to, sorry, you have to expensify it in the books of accounts. You have to show it in the profit and loss account for this year, irrespective of the cash inflows. Now, suppose you pay in advance subscription fee, right? So 3-year subscription software you have purchased, you have purchased it for 3 years, let's say. Now, the expense that is related to, you have paid out for 3 years, but that expense that relates to this year is only the 12 months. So that means the next 2 years amount you have to defer. You have to consider it as prepaid expenses. You might have received the amount in advance from your customer, but you're yet to give the service to defer that revenue. So all this concept comes from where? It comes from the accrual concept. Lastly, the accounting equation. So this is the crux on which your balance sheet is presented. That is, your assets is equal to liability plus equity. Now, what is assets? These are the value owned or possessed. These are the things or value that is owned by the business. Liability is something that you owe to the others, that is to creditors and outsiders. Equity is nothing but yours, that is the owners or investors. It's nothing but also called as net worth. Going to the next slide, that is double entry system of bookkeeping. Remember, this is also one of the basic principle of bookkeeping, like the 10 other pillars, but I'm separately discussing this because this carries a lot of importance. Now, whenever you look at a transaction, it will always have dual aspect. Remember, that is why it is called double entry. Double means two. Okay. So let's say, simple example, I pay rent. So rent will be one aspect and I have to pay it, right? So bank will be the another aspect. I invest capital in the business. So there's cash coming into the business. There's also, I owe something to the creditors, to the owner, right? I am a business. So I get the capital. So that means cash comes in, but also I owe to the owner of the business. So there's capital. So that way, every business transaction will have two effects, one debit, one credit. Now, there are a lot of accounts that you have to understand. There is nominal account, there's real account, and there is personal account. Now, what is nominal is revenue related. Revenue and expenses are called as nominal accounts. Example, salary, rent, income that you earn, sale of goods, sale of purchases, interest income. So all these are related to the revenues and expenses, and these will be termed as nominal, and they have to be closed at the end of every year. The balance cannot continue to the next year. Next come real accounts. Now, what is real accounts? Nothing but the assets owned by the business. It can be goodwill, it can be cash, it can be land, it can be building, it can be equipment, furniture, investments that you hold, cash amount that you hold. These are all physical assets that you own, right? And these balances are permanent and will be carried forward. The closing balance will be always carried forward to the next year. Next comes personal account, nothing but that there are natural persons, representative persons. Now, I, you, creditor, debtor, capital, drawings, all will come under personal accounts. Now, what is the concept of debit and credit? So now you know there is nominal, there is real, there is personal. What is nominal? Revenue and expenses. What is real? Asset related, all assets. And what is personal? Debtors, creditors, owners. These are personal accounts. There's four types of accounts, that is assets, Expenses, liabilities, equity, and income and revenue. Income and revenue is one and the same. Okay. Now, what is the debit and credit rule? This is the crux. Again, I tell you, this is the crux of accounting or bookkeeping. So this is how you put the entry, the first entry that you do in the record keeping, that is a journal. This forms the basis for that recording. When it comes to assets, what is the functionality? If there is an increase in asset, you have to debit it. If there is a decrease, credit it. Expenses, same rule that applies for asset. Whenever there is an increase, debit it. Whenever there is a decrease, credit it. Liabilities, reverse. Liabilities and equity is liabilities, equity, income and revenue is the same. Whenever there is an increase, credit it. Whenever there is a decrease, you have to debit it. Now, don't ask me why is this rule, because these are nothing but the concept. This is core. So 1 + 1 is equal to 2. Now, how do I explain that? It's simple. It's simple as that. So these are the principles on which it's like a science. It's more like science. Okay. So now debit, increase an asset or expense account, and decrease equity, liability, or revenue account. So simply remember this table, that will help you to understand any entry that is posted in the books of accounts. I will not focus much on golden rule of accounting. You can just go through it. Debit the receiver and credit the giver. It's something which is related to personal account. Debit what comes in and credit what goes out is related to the real account. Debit expenses and losses, credit income and gains is related to my nominal account. This is a gist. So either remember the golden rule of accounting or remember the 5 core type of accounts, debit and credit rule. The end result of your journal entry by applying 1 or 2, either of the 2 will give you the same results. Next. Now, what is bookkeeping process? Now we will come to the crux that's regarding the bookkeeping process. First is what? Recording, nothing but journal related. Second is what? Classifying, ledger related. Third is what? Summarizing, trial balance related. Next is reporting and interpretation. Nothing but it relates to financial statements. Now, what is journal? As and when you incur, you have a business transaction, you record it. As and when means what? Chronological order. In the order of the event that is happening, in the order of the business transaction, you have to record the transaction, you have to capture the data. Now you have the format of journal entries here. How do you pass it? So it's more like a record that you have, wherein you have date, you have particulars, you have ledger folio, you have amount, you have amount of debit and amount of credit. So this is how you have to record. Name of the account to be debited, name of the account to be credited. One single entry I will tell you. Okay, just for your understanding. Rent expenses paid for the month of May. Okay, it is paid on 1st of June. So under the date column, I write 1st June. Okay, then name of the account to be debited. What is rent expense? It is a expense account. It is a nominal account. What happens when expenses increase? I have to give a debit to it. So rent account debited with whatever amount is paid. Now, what is the corresponding credit? I pay it out. Pay it out means what? To bank account, right? So how much amount, whatever is paid, I have to mention under the credit column. Narration. Now, what is narration? Nothing but the description. Being rent amount. So it starts with being what? So being rent amount paid. That's all. So that is nothing but journalizing. Now, what is the next step is preparing the ledger. Now, what is preparation of the ledger? So ledger is nothing but when we have to classify all the rent that is paid over, that is incurred over the accounting period, should be classified in one single head under the same head, that is rent account. So I record all the details here. This is called a ledger. The general ledger is a principal book of accounts and bookkeeping. It's a collection of similar type of transaction into the same head. So it is T-shaped. It will have debit. It will have what is the name of the account. It will have a credit. And now what is the entry that will come into this? So you will have to mention it was the entry that you posted was rent account to bank, right? So on the debit side, you have to mention to bank, so and so balance. Okay, that is called as posting to the ledger. And lastly, Now, over the months, if you pay 10,000, what will be the closing balance at the end of the year? It will be 1,20,000, right? So now rent account total balance is 1,20,000. You have to summarize it somewhere. You will summarize it under trial balance. Like rent, you will have several other heads. You will have sales, you will have salary, you will have admin cost, you will have purchase of asset details, your purchase of goods details. Like that, you will have n number of accounts. So all the summary, you will put it under the respective head and write the amount against it. So that is called as trial balance. Now, why is trial balance prepared? This is the basis from where your financial statement will be prepared. Trial balance should match. Debit balance should match your credit balance. The total that you see, right? The total, you have something called as a total here. So this total of both the sides should match. If it doesn't match, what? If it doesn't match, there has been some errors. There has been some errors while you, from journal, when you took to ledger, you have done some mistakes. There has been error of casting. There has been error in one account. In one place, you have taken the transaction. In other place, you have not taken the transaction. So something has gone wrong, and that is why the trial balance will not match. Okay. That's regarding trial balance. Now, there are cases. Trial balance is not 100% accuracy that you have done. If it matches, it doesn't mean that all your book of all your journalizing and ledgerizing is perfect. You know why? Because there might be errors of principle. Meaning, furniture, you had to take it under furniture head. You have taken it under office supplies. Okay. So the amount will match here in debit balance. Both are debit balance, right? Furniture is an asset. Office supplies is an expense. Both will have debit balance. It will properly reflect here. But is the concept applied correctly? No. Suppose you have forgotten the passing of the journal entry. There's no journal entry pass. There's omission. In that case, what will happen? Again, your trial balance will match because that entry 100% is omitted. There's no debit also. There's no credit also. But there is still a mistake that you have done. That is omission. You have omitted to post a journal entry. So that's regarding the primary books, journal, ledger, trial balance. Once trial balance is prepared, we move on to the next, that is financial statements. Just a minute. Okay. Understanding financial statements. Now, what is balance sheet? What is profit and loss? What is cash flow statement? What comes first? After trial balance preparation, what comes next is the profit statement, wherein you put all the nominal accounts, because I told you nominal accounts are to be closed at the end of the year. So you summarize the revenue, you put the expenses, you put the revenues. What is the differential figure? Nothing but the profits. Okay. Now, in profit statement, you will have operating incomes, you will have operating expenses, you will have non-operating incomes, you will have non-operational expenses. There's a lot more in this. And then there is concept of profit before tax, profit after tax. So all this is nothing but a result, the result of the financial performance of your business. Okay. And next comes balance sheet. I can say profit statement is like a report card of how your business has performed. Balance sheet. So once profit and loss statement is prepared, you move on to the next, that is balance sheet. Now, what is balance sheet? Assets is equal to liability plus equity. Your balance sheet is structured on that equation. So it summarizes the assets owned and the liabilities owed by the business. So in under assets, you have long-term assets, you will have current assets. Liabilities, again, you will have capital, that is nothing but which goes to the owner. You have long-term liabilities and current liabilities. Now, with balance sheet, what can you ascertain? Again, the financial position, what you owe, what you have to receive, where have you invested, what is the bank balance, what are your capital assets, what are the fixed assets, what is the written down value of the fixed assets, all that is summed up in a balance sheet. Next comes cash flow statement. What are cash flow statements? Now, your whole of the business activity, I can classify into three streams: operating, investing, and financing activities. Now, operating means what? Purchases, sales, operational expenses, operational revenue, depreciation that you incur, salary that you pay for the operational staff, all this comes under operating cash flows. What is investing cash flows? You invest on fixed assets, you invest in land, you invest in building, you sale of the plant and machinery, you earn some income on the sale of that plant and machinery. It is not operational, right? Because fixed assets are not operational. It's not goods or something to you. So that comes under investing activity. You hold some investments in mutual fund, you get dividend, you get interest on such investments that you make. That is all under investing cash flows. Next comes financing cash flows. Now, what is financing cash flows? You borrow loan, you have to pay some interest on that loan. You pay dividend to the investors, you pay dividend to the equity shareholders. All this comes under financing cash flows. So now what does cash flow statement do? It summarizes how much is the inflow, what comes in, how much is outflow, how much cash goes out from each of these activities relating to operation, investment, and financing. So that's with cash flow statement. And then there are key concepts like what is difference between revenue and profit. So whenever someone asks you revenue, turnover, sales that you make, sales volume, it all means it is something that you have before deducting all the expenses. What is profit? The end result of what you have derived from your business, that is through making so much sales, incurring so much expenses. What is that you have derived net? That is called profit. Now, what is difference between budget and a forecast? Budget is nothing but a financial planning for your spendings. It's more or less related to the expenses and it is for a definite period of time. Whereas forecast takes into picture both your future planning into it involves both the future planning related to the revenues and your expenses. Next, very important term is burn rate and break-even point. This term burn rate is usually used in most of the startup. What is burn rate? It is nothing but how quickly you are spending out you're spending your cash reserves to cover the cost. So usually it is when it comes to the loss firms who are not making any revenue as such. So they have only cash reserve and they are making payments from such reserves to meet their expenses because they are not able to make any revenues. So usually investors are more concerned about what is your burn rate. So it's nothing but how quickly your company is spending the cash reserves. So if you have a higher burn rate, it is not a good sign. Okay. And lastly, what is break-even point? So what is break-even? It's an equilibrium point where your total costs are equal to your total revenue. And you're okay at this position because you're not even making a loss or a gain, but you're always striving to go above a break-even point. Lastly, compliances. Now, this is again a major segment. Why should you comply? What is the need for a startup to comply? What is a compliance? Why should you do it, right? Now, adherence to the laws made by the government for business is nothing but compliance. It's nothing but adhering to the laws. And remember one thing, ignorance of law is no excuse. So whenever a notices come, whenever penalty notice comes to you, whenever you are asked for a personal hearing, do not say that I do not know the law. I did not know that I have to comply with this or that, because ignorance of law is no excuse at all here. Okay, and compliance is nothing but the set of duties every business is required to perform. Why do government have made some compliances for us to follow? That is because they want to regulate the business. They want to know what we are doing. They want to see that the business are on a legal are doing all the legal compliances. Okay, now how and why to do compliance? First of all, you have to understand all the statutory requirements that you as a startup should follow. Pay taxes, file your taxes on time. Apart from filing taxes, also there is something called as reporting to the government. So they may ask certain reports from you. They may ask certain registers related to the payroll. So all such information you have to provide them on a timely manner. So that is also, if you fail to do that, also you will get notices, you will get penalties. Trust building. So only if you have if you are 100% compliant startup, there is a trust from the outsiders on your business. Again, you get several government benefits only if you comply with the law in all terms. So again, it is to keep the business legally safe. It is to avoid penalties and notices that you should comply with all the rules and regulations, and helps in due diligence. So due diligence is something that comes up when an investor wants to invest in your company. He wants to know where are you in terms of legal terms. I mean, where are you in terms on the legal aspect, whether you're complying or not, whether there is a risk of certain notices coming into the picture, whether there is penalty due. So all this comes into the picture during due diligence, and if you have a clean report of compliances, then it's superb. So you can secure funding in no time. Again, valuation of business compliances play a major role in it. Now, what are the basic compliances that you have in India? First of all, relating to registration, which is already covered in the first session. What are the applicable registrations? GST, income tax, payroll related, you have professional tax, provident fund, ESI. Again, there is withholding of taxes that you're required to do, and there are n number of labor laws that you should know about. Next comes obtain applicable credentials like PAN, TAN, import-export code. These are a very must for every organization. Keep proper records, invoices, vouchers, bills, bank statements, your salary registers, financial statements, audit reports. So see that you maintain these records and just not, ignore these. Then comes the filing of all the returns on time, the TDS payment and returns. All these are several compliances. And most importantly, when you are served a notice from the department, see that you answer it on time. Do not ignore any kind of notices. Okay, so that's regarding compliances. So if you have any questions, you may ask. Otherwise, I have already been I think we are just running late. Give me 5 more minutes. I'll just complete these questions quickly. 1 second. I'm just looking at the questions that I have.
Deepika, a few questions are already
Hi,
covered.
may I ask you a question?
Yeah,
Please
sure.
go ahead.
Actually, I might have missed that part, but just wanted to understand about this, how to calculate this burn rate. Because many times it happened that whatever expenses we are incurring at, the first year of running the business, that might go up in the next year, and we might not have an idea. So when it comes to calculating a burn rate, because that is something which is required when we are asking for funds. So then how to deal with that? Do you have a suggestion around that?
So burn rate is usually whatever is your opening cash balance and the month end or year end cash balance divided by the number of months. This is how you arrive at the burn rate. So it's basically you take the whole of the period into account, whole of the period that you are into consideration. You're calculating the burn rate. You take that period into account. That becomes the denominator, and whatever expenses that you have incurred. Okay, that is the opening cash balance minus the closing balance, that becomes the numerator, and that's how you calculate the gross burn rate. If you want to look at the net burn rate, then it's the gross burn minus the revenue that you have earned during the period. So if you can repeat your question now, how to adjust it, you will have to be more precise for what period you have calculated the burn rate. I think that might suffice, but yeah. You can go on.
Okay. Maybe with I'll share my experience. We got a funding for maybe around 18 months, and that we calculated based on our understanding of exactly how much expenses we've been incurring for that initial development. So then after a year, maybe after 12 months, we realized that okay, fine, 6 month amount, 6 month is remaining, and this much amount is pending. So we need to generate more funds. So then we started looking for more funds. So everywhere they were asking exactly what is your current runway, how much is your burn rate, and if you are asking for maybe around whatever amount you're asking for, then how much of duration, and then when will be raising your next round, and how much will be that round. All those questions started coming in. So we were not very sure, because in starting 12 months, everything was related to the, what do you say, the development part. But let them, as we move towards the finalization of the product development, there are many expenses which come in. So then when we need to tell them exactly how much we need, and based on our current run rate,
Understood.
and how to balance that thing. I'm sure
Understood.
you must have come across this issue. So would
Okay,
like to have your comment.
So let's say you are on 31st of May right now, and you want to have a funding for the next 6 months, as in you're looking to meet up the funds for the next 6 months, let's say, and you have an estimate of the cost for the next 6 months. It's going to be let's say a 10,000 every month. That's a 60,000. So 60,000 divided by 6 would be the burn rate. So that would be the current burn rate, to be more specific.
Okay.
Hmm.
Okay, so basically we have to look for the based on our current expenses which we are incurring.
Correct.
We have to calculate our burn rate.
Absolutely. Right.
Okay, understood. Thank you.
Yeah. Monisha, any other questions?
Yes, Deepika. In the chat.
Otherwise, I'll answer the questions that I have, because you had circulated a couple of them to me, right?
Yeah.
Okay. So quickly, first question was just 5 more minutes, guys. I'll wind up soon. Could you provide a brief overview of key financial statements? That's already on
Deepika,
slide.
your screen is not visible.
Okay, 1 second. Visible now?
Yes.
Okay. The first question was, could you provide a brief overview of key financial statement, income statement, balance sheet, cash flow statement, and their importance for startups? It's already covered on slide 10. So income statement is more or less to know what is the profit of the concern. It's a report card. Balance sheet is when you know the financial health, or more or less the financial position of the business. And cash flow statement, I've elaborated. So where you are spending, how much it is more or less the spending pattern of your organization. Spending and earning pattern in terms of cash inflows and outflows. What are the best practices for tracking and categorizing expenses effectively? Again, this is provided in slide 5. The tracking outgoing expenses and incoming revenues. How can startup create accurate budgets and financial forecasts to manage cash flow and plan for growth? So first of all, when it comes to accurate budget and financial forecast, the few aspects that you have to keep in mind is what industry are you in, what are the benchmarks, what is the market standards, what is the historical data. These become the 3 key factors. And then you will have key performance indicators based on which you prepare the budgets and financial forecast. Also look at all the 3 situations. You will have optimistic market, you will have a pessimistic market, you will have a mid market. So your forecast should be based on all the 3 aspects. Okay. And then comes, are there standard charges for CA bookkeeping services for pre-revenue bootstrap companies? No, there is no standard as such, because it's depends on several factors. So it depends on the volume of transactions. It depends on the nature of the industry as well. So there is nothing specific as a standard charges. What are some software tools, preferably free, best suited for bookkeeping and related tasks for startups? You have Tally, you have Zoho Books, you have Marg, you have Profit Books, and then you have Vyapar. Most of them have a free version for a startup. But then what happens is you will have a lot of limited features. You will not have all the reports, automated reports that a paid version gets. Also, you will have a limited storage. So just look into before you go for a free version. What are the most common bookkeeping mistakes or pitfalls startup makes, and how can they be avoided? Common bookkeeping mistakes, I would say, first of all, that is mixing up your personal expenses with the business expenses. So there's just two whole thing, messed up. It's a complete confusion because it's difficult to track the expenses and the incomes if you have a mix up of both personal and financial and business transactions together. Secondly, I would say. The expense categorization, that's mixing up again between, there's no proper categorization of the revenue and the capital expenses. Income seepage, that's income leakage, you're not looking into a proper sales tracking. Then there is no proper recognition of the revenue, that is, you're not deferring the revenue, you're not able to understand the concept of deferment of revenue and deferment of and prepaid expenses concept. So it's better to seek professional help when you are very new to this. So it's more or less, nowadays people have started doing yourself accounting, bookkeeping, which more or less makes a total clumsiness is there in the bookkeeping process. And again, you depend on your relatives, you depend on your friends, you have no idea of what's happening in your books. You do the entries based on your memory and not on evidence. There is no record of the transactions. There's no record keeping. You do not have a proper supporting attached. So all these are common bookkeeping mistakes that I say. What are the key bookkeeping practices crucial for startups operating in the e-commerce industry aiming to reach a global customer base and scaling rapidly? Okay, when it comes to e-commerce, what becomes important is make everything automated. So go for an accounting, because you will have a huge volume of transactions, right? So it's better you have an accounting software. Firstly, then you will have multiple currencies. If you're looking at the global customer base, then it means there should be a close watch on the multiple currencies engaged, which means you should have a real-time conversion of your monetary terms. And then also you should know about the global regulations, global tax regulations, at least of those places where you have a customer base. Okay, that's all I can think of now when it comes to the question number 7. Next, the question is, okay, what is the quickest method for startups to learn about laws, compliances, regulations, conventions of a new country's market they want to enter? Ideally, there is no quickest method as such, but I would suggest a few wherein you have a lot of online learning platforms, avenues, maybe the government side of those countries. Statutory bodies like ICAI have a lot of learning courses, and again, please go for government sites only, because you see a lot of articles published nowadays, but not sure if those are genuine. So please go for authentic reading, authentic records only. And other quickest method is always go for seek a professional help, and start with simpler basic things like what is relevant to you. So maybe if you're looking at the UAE based taxation, you would like to look at the simple things that applies to you, maybe the VAT, maybe the corporate tax. So it's not possible to grasp all the regulations and conventions at once. So it should be like one-on-one approach at a time. How to make ledgers and journals effectively? Of course, I would suggest a good accounting software for this, because the moment you enter the journal, you book an invoice, the ledger is already prepared, the trial balance is already automated, the financial statement is automated, you get automated reports. So accounting software is one good thing, and chronologically recorded, that is, do not miss out on any entries that you make, and keep a good record keeping. Have every entry that you record in the book backed up with a proper document, that is supporting document. How can startups ensure tax compliant bookkeeping and easily manage their accounts? More or less, you should know about the tax requirements here. in order to be compliant. For example, I did mention bill payment processing, 10,000, about 10,000, not to be paid in cash. So you should know about the statutory requirements. Again, for this, yeah, you should be aware of the law. Yeah. So I think those were the questions which I had received. So if there's anything else, please let me know.
Yeah. Are there any other questions? From the participant side? So the address questions were actually while registering, the participants are given. So that is covered right now and during the session. If you have any questions. Yeah, I guess Deepika, it's clear for them. So
Okay. Thank you so much once again for the patient listening. I am so sorry if there were technical glitches in between because of the network.
yeah, it's fine. It's fine. Let's give Ms. Deepika a round of applause for that insightful presentation on basic bookkeeping practices for our startups. Thank you, Deepika. Thank you so much.
Thank you, everyone. Have a good day.
Monisha, I'll just
Bye.
come in once.
Yeah, sir. Sure.
Yes, we all need to extend our deepest gratitude to Deepika for first and foremost taking her time out and in a very elaborate and detailed manner, she has guided all of us through as to what is bookkeeping and what are the must-know things that we must do and what is it that compliance is all about. It's just like health. I always keep telling financials and bookkeeping is just like health. You get sugar once, you get diabetes once, and it is forever. Just like that, your book gets spoiled once, it's gone forever. So startup is, as we say, it is a baby steps as we take it, because the vision is a future and wherein we see a big organization, a big company, but the footsteps are a small steps that we take now. So systems and the internal controls, if at all it has to be put in place, it has to be at the commencement and the early days of any company. So today's I have been actively listening to Deepika. She has done a wonderful job. Compliments on behalf of all the participants, Deepika. And also to BCL team, BCL India, for their constant support in us organizing and hosting this startup CA series. Both Pawan and Deepika have thus far given us enough insights for us to start a company, and once started, in what format to start, and even after that, how to maintain the basic books of accounts. So I'm very certain the delegates have been enriched with your thorough and rich knowledge, as well as it will go a long way and support most of the startups who have joined here. And on behalf of all those who are present, I once again, and on also behalf of our Institute of Chartered Accountants of India, the Mangalore branch, as the chairman, I extend our deepest gratitude to you and also request you to keep up the support. And also to all the ecosystem partners and the participants, thank you all for having faith in this entire concept of Startup CA series. The only objective is to make sure we handhold you and give you the right perspective and the right know-how knowledge, because when chartered accountants who have done it come and share their insights and knowledge, it will only be handy for you, because there will be many people here who would want specific topics. So as Monisha rightly said, it will be a series of sessions that we will have in the course of next few months. And I'm sure each of your thoughts and going forward, you will slowly accelerate and take it to one notch higher, because you are still at the basics. Going forward, there will be much more that is to be known and answered. With this, I thank you all once again, and have a great evening, guys.
Thank you so much once again, Gautam. It's indeed an excellent initiative. And also, I wish a very best to all the entrepreneurs. May all you turn into a unicorn one day. Yeah?
Yeah, yes.
Thank you
Deepika,
so
yes.
much. Yeah.
So,
Bye-bye. Take care.
Deepika, can you
Yes.
share your email ID in the chat
Yes,
so that
yes,
they
for
can
sure,
contact
for
you
sure.
if they have any questions? Yeah, guys.
Yes,
So
I'm doing it. I'm doing it right away.
yeah, Deepika. Sure. Last but not the least, as Gautam sir said and thanked everyone, I would like to thank all the guests and participants who joined today, and your presence was very immense, appreciated. And be sure that make use of the further 10 sessions also. So we would like to share you the feedback form. I'll share through emails and I have dropped in the chat box. Please fill that. In that, there's a question that what future topics you would suggest for us to conduct this series. So based on that, we'll keep our future topics for the future session. So we'll consider your suggestions. And Deepika has dropped her email ID, so you can contact her directly if you have any doubts regarding the today's topic. And we have created a WhatsApp group so that we keep updated you for the further sessions. And we have the recordings of the sessions updated in the WhatsApp group, and the PPTs which speakers have used. So it would be very helpful. So thank you everyone, and we hope you enjoyed today's session. Yeah, Deepika. Is there
Yes.
anything?
Bye.
Yeah, thank you. Thank you all.
Just a minute, Monisha.
Yes,
Friends,
sir.
kindly give your fair feedback and what topics, as Monisha rightly said, what is it that you want to know, so that we also curate the sessions accordingly. Now, we may want a lot of things to be said, but what exactly if you want, if you can put forth over a period of next few sessions, we can consider it and curate it in perfectly blend with the what most of you need, so that the purpose is served. We speak one thing and the requirement is something else, then that may not be as effective as desired. So as Monisha rightly said, give us your fair feedback, as well as just let us know what is it that you want to know from our side, so that we can have sessions on the set topic itself. That's it.
Yeah. So that we will come up with the curated webinars, and we'll make sure that the technical issues and the issues which we face, we are facing in the future sessions. So yeah, thank you everyone. This is Monisha signing off. Thank you all. Have a great evening.